What is up, everyone? In this video, I want to talk to you about dividend investing, especially the three main misconceptions when it comes to investing in dividend shares. Now, if this is your first time here, my name is David. Welcome. I do videos on personal finance and entrepreneurship weekly.
Which really just means that I do weekly videos on how much of a cheaper I am, and because I don't have a job, I'm just gonna call myself an entrepreneur.
On a serious note, I've been building my portfolio since the beginning of 2019. And as I mentioned in my passive income video, investing in dividend shares is one of the key ways of how I'm generating the majority of my passive income. And just so that you know as well, I'll leave a screenshot somewhere here that I currently have $32,000 invested in the share market, and it's generating me approximately $879 last year, which is 2019. And which is approximately $73 a month. Now, it doesn't sound like it's a lot, but over time, it's gonna grow to the point where I can be financially free when I'm 35. Along the way, I have done a lot of research on dividend investing, as well as learn a lot just investing myself. So I'm hoping to use this video as a way to share with you what I know. And before we get started, if at any point you learn something brand new, make sure you destroy that like button so that I can buy some proper razors and remove these dirty, disgusting little Asian mustaches, okay? Now, without further ado, let's go. So before we jump into explaining the first misconceptions of dividend investing, it's worthwhile just quickly explaining what dividends are, what is dividend investing, as well as how it works. Dividends, put very simply, is that when you spend $1,000 to buy shares, you own a very small percentage of that company. And because you own a very, very small percentage of that company, you're entitled to some of its earnings. And the company can choose to pay those earnings out in either quarterly, monthly, or even yearly basis. It's up to them. Let's say you spend $1,000 to buy Apple shares, and the dividend yield is 5%. At the end of that year, that $1,000 will become $1,050. And that $50 is what we call dividends. To build on that concept, dividend investing is essentially creating a portfolio of stocks that's like Apple that can generate a very steady, consistent stream of passive income. Also, as that steady, consistent stream of passive income entering into your account, a lot of investors like to reinvest that dividend to get more of those shares so that next year they'll get paid even more dividends. And before you know it, your portfolio is going to be so big that generates so much passive income that you can go yum cha without looking at the receipt or even checking your phone whether you have enough money to pay for that meal. And my friends, that is what I call financial independence. Now that the fundamentals are out of the way, let's talk about the first misconception of dividend investing, and that's high dividend yield stocks are the best. Now, to that statement, I call boom. I don't want to swear, so then YouTube will demonetize me, but I will bleep that out. What a lot of investors do when choosing and building their dividend investing portfolio is to use dividend yield as a guide. Now, there's nothing wrong with using dividend yield as a guide, but there is something wrong if that's all you use. Now, let me explain. Let's look at how we calculate dividend yield, and I'll put that formula on the screen right now. So dividend yield is calculated by annual dividends divided by share price. Now, annual dividends is the total amount of dividends that was paid throughout the year, and share price is just share price. Let's put it into a more practical example. Let's say the total amount of dividends paid that year was $1.50, and the share price at the time is $25. If the total amount of dividends paid is $1.50 and the share price is $25, our dividend yield is 6%. Now, if the share price goes down and the dividend stays constant, which means stays the same, dividend yield would actually go up. So this is the thing. Companies don't have to pay dividends, and dividends are paid out of companies' earnings. If the company's earnings are slowing down, or they're carrying too much debt, or they don't have a healthy amount of cash that they're holding, it's unlikely that they can pay the same amount of dividends as the previous years. Therefore, slashing their dividends this year if their earnings are slowing down or the market conditions have worsened. When their earning capabilities is starting to slow down, the market will actually anticipate the move of slashing dividends into the future, and therefore the share price would actually adjust before the company announces their slashing of dividends. So, when constructing your dividend investing portfolio, make sure that you look beyond just the dividend yield and don't just use that as a guiding post. And some common places that I always like to look at when evaluating dividend investing stocks is that I like to know how much cash they're carrying, how much debt are they carrying, and whether their earnings have been strong and whether the earnings have been growing year on year. Now, the reason why I like to look at cash is that dividends are paid out of earnings and they're usually paid as cash dividends. If they don't have enough cash, how are they meant to pay you dividends? Now, if they're carrying too much debt, companies always have to meet their debt obligations first. So if they don't have enough cash to meet those debt obligations, then it's unlikely that you're going to receive any dividends. Lastly, you want to look at their earnings growth year on year, because if they aren't growing as a company, similar to the cash situation, how are they meant to pay you or distribute dividends to you when their earnings aren't growing? So the second misconception when it comes to dividend investing is that dividends is the same as interest.
What? Not at all.
Let me explain. Instruments like bonds calculate yields very similarly to dividend yields. But the interest paid to bondholders are an obligation and absolutely not optional. On the other hand, company dividends are totally optional and they're not obligated to pay dividends at all. And when a market downturn happens, dividends are usually one of the things that the company slash in order to meet debt obligations. So it's important for you to know that when you're evaluating a dividend stock, you want to know whether the company have a very strong track record of distributing dividends, as well as whether those dividends over the years have grown. The bottom line is you really do need strong earnings to distribute dividends consistently. And if they can grow the amount of dividends that they distribute, it's an even better sign. So the third misconception is timing the market. Now, look, you're not an oracle, and neither am I. But if you have successfully timed the market for the last 10, 20 years, and you have done that profitably, please say, I have in the comments below, because we need to get in touch and I need to give you all my money.
And that way you can make me rich and I'll no longer have to do YouTube videos.
No, I'm just kidding. I really do love YouTube videos, so don't leave me, guys. I wanted to say that I will probably have a higher chance walking down the street and finding $2 than someone successfully timing the market consistently over the last 10, 20 years. Bad jokes aside, I want to quote you some statistics. Now, according to a Bloomberg report, $16 billion was pulled from the US stock funds in 2009 when the stock prices were at its lowest point in a decade. Now, if they didn't pull out, it's likely we're gonna have a lot more people who's financially independent. We're crap at timing the market because we're emotional. We're prone to let that emotion get the best of us. And I just wanna let you know as well that I don't try to time the market at all. I set aside a certain amount of budget every month and I invest that money straight away, whether the times are good or bad, and I just do that consistently. This is a short video, I know, and these are my closing thoughts. Dividend investing is a long game, and so is generating passive income and also being financially independent. But the next time that you're evaluating a dividend stock, make sure you look beyond just the dividend yield and look at the general health of the company, whether they can keep up with that dividend yield, whether they can even pay you a dividend in the future. It's worthwhile for me to mention that I'm not a professional, so make sure you do your own research, come to your own conclusions, and if you need to seek expert advice, make sure you go seek a professional for expert advice. Lastly, if you enjoyed this video, destroy that like button so that YouTube can share this video with more people. Subscribe to my channel for more videos like these. And before you go, which dividend investing misconceptions shock you the most? Let me know in the comments below so that we can have a conversation. And until next time, thank you for watching this all the way to the end. It means a lot to me, and see you soon.